In this video, I'm going to provide you with 3 compelling reasons to invest in index funds. As with everything in life, there are some things that you actively participate in and some other things where you are just a bit more passive. Active participation is when you are directly engaged and involved in the outcome. Passive participation is just the opposite, wherein you observe the proceedings without directly influencing the activities or their outcome. And when it comes to investing, these same principles apply. You can actively invest in specific stocks and create a portfolio, or you can just invest in a basket of stocks selected by someone else using predetermined rules. And that's where index funds come into play. Now, index funds are passive investments that anyone can invest in regardless of your current wealth, how much money you make, or how much money you were born into. Speaking of being actively involved, if you could hit that thumbs up button, the subscribe button, and the notification bell, it would be greatly appreciated. Investing in index funds has long been considered one of the smartest investment moves that you can make, and that's the reason a bulk of my own personal retirement is in index funds. If you are new to index funds, an index fund is a type of mutual fund or an exchange-traded fund, which is essentially a bundle of securities that collectively track the performance of a market index, such as the S&P 500. And since they are passive in approach, index funds do not aim to beat the market or beat the underlying index they follow. The whole goal of an index fund is to track the performance of the underlying index as closely as possible. And index funds come in a wide variety of different flavors. They can be focused on certain sectors, certain geographies, or certain stock exchanges. There are literally hundreds, if not thousands, of index funds out there offered by companies like Vanguard, Fidelity, and Charles Schwab. And index funds are endorsed by Warren Buffett, arguably the greatest investor ever. And speaking of Warren Buffett, there's a great story about Warren Buffett and index funds. In 2007, Warren Buffett made a $1 million bet that an S&P 500 index fund would beat the returns of an actively managed hedge fund over 10 years. And he won in a landslide. And if you want to know more about an S&P 500 index fund and see why it's perhaps the best investment ever, watch the video that I did a couple of days ago, and I'll link that below. The most obvious benefit of investing in index funds is that your portfolio becomes instantly diversified, minimizing the likelihood of losing some or all of your money. Let's use an S&P 500 index fund as an example. Now, an S&P 500 index fund tracks the S&P 500. This index fund would hold about 500 different stocks, and while the performance of each of these 500 stocks fluctuates over time, you don't have to worry about individual stocks because you've invested in all 500 companies within the index. So if Amazon falls 10% over the next week or so, you've got 499 other companies to pick up the slack. And that's why, since its inception, the S&P 500 has earned an average return of around 10% per year. Of course, there will be years when you experience lower than average returns or even losses, because even the S&P 500 isn't immune to volatility or going down. However, by investing in the S&P 500, you're almost guaranteed to see positive returns over time. Despite all of its crashes over the years, the S&P 500 has always recovered from each and every one of them. Now, you may not experience explosive returns overnight, but you're also far less likely to lose everything like you might with owning a handful of stocks. Diversifying your portfolio among so many companies by investing into just one index fund ensures that the value of your portfolio is not overly correlated with the fortunes of any one company listed in the index. And again, just to be clear, the S&P 500 index fund is far from the only index fund that you can invest in. It's just the one that I recommend to most of the people that I talk to. Just take a look at this chart that I pulled from the Fidelity website. Now, Fidelity posted this list to demonstrate how Fidelity index funds are cheaper than their Vanguard counterparts. But I want to use this list to show you all of the variety of index funds available. You've got large cap index funds, you've got mid cap index funds, emerging market index funds, and the list goes on. You can even invest in technology index funds, energy index funds, and ESG compliant index funds. Literally, there is an index fund available for just about any type of investment out there. Another major benefit of investing in index funds is that the costs, including taxes and management fees, are in most cases lower than those associated with other types of investment funds. The first cost to consider is the management fee each fund manager annually collects. The amount of the fee, which varies based on the value of your holdings, is determined by the fund's expense ratio. And every fund, whether it's a mutual fund or an index fund, has an expense ratio. Generally speaking, actively managed mutual funds have expense ratios that often range between 1% and 2%, and most of that fee pays for portfolio managers to make buy and sell decisions in an attempt to outperform the overall market. Index funds, on the other hand, are passively managed, and since they simply track an index by buying and holding all of the stocks in that index, the stocks in an index fund rarely change, and this is often referred to as a low turnover ratio. And when you couple the low turnover ratio with the fact that index funds are mostly automated using computing power, the expense ratios are extremely low. To show you why expense ratios matter, let's say that I have $20,000 that I want to invest. Now I'm going to put $10,000 in a Fidelity 500 index fund with a 0.015% expense ratio, and let's say that I put the other $10,000 in an actively managed ETF with a 0.7% expense ratio, which is fairly common. Now let's assume that over the next 20 years, both funds have an identical 8% a year average growth rate, and let's assume that I didn't contribute a single penny or a dollar to either fund. With the index fund, my money, accounting for the 0.015% expense ratio, would have grown to $46,480.27. With the mutual fund and its 0.7% expense ratio, that same $10,000 would have grown to $40,925.54. By investing in an index fund, you saved over $5,554 in fees over the course of 20 years. And I only used $10,000 as an example, and the reality is that most of us will contribute a lot more to our savings or retirement than $10,000. As you can see, expense ratios matter. They can literally save you tens or hundreds of thousands of dollars in management fees over decades. And that's why index fund investing is sort of a no-brainer, especially when an S&P 500 index fund outperforms the majority of mutual funds and ETFs at a fraction of the price. And that leads me to the third benefit of index funds. The third benefit of index funds is that they actually offer attractive and steady returns that can't be beaten by most portfolio managers that run actively managed funds. According to research by Standard & Poor's, only about 23% of actively managed mutual funds outperform the S&P 500 over 5 years. Yes, there are certain companies and certain funds that outperform the market, but there are also lots of companies and funds that underperform the market. But one thing is for certain, and that's that the overall stock market increases in value over time. And that's why index funds are such a great investment. They offer a ton of diversification, they are really cheap, and they generally outperform other funds that charge outrageous fees that don't guarantee returns. And in case you're curious, you can invest in index funds through your brokerage, or you can use a mutual fund company like Fidelity Investments or Vanguard. Personally, I use my brokerage, TD Ameritrade, and I buy index fund ETFs instead of index fund mutual funds. I like buying the ETFs as opposed to the mutual funds because I can buy them inside of my brokerage account, they have lower account minimums, and they're just simply easier to trade. As an example, when I buy index fund ETFs on TD Ameritrade, I'm not restricted to any one index fund provider. I can buy Fidelity index funds, I can buy Vanguard index funds, or Schwab index funds, or whatever other index fund provider I want to use. Index fund ETFs also have lower account minimums than mutual funds. As an example, let's take a look at Vanguard's S&P 500 Index Fund ETF, and as you can see, you can buy one share of the ETF for roughly $388. And if we go to the corresponding Vanguard S&P 500 Mutual Fund, which is essentially the same thing, you'll see that it has a $3,000 account minimum and actually has a higher expense ratio at 0.04% opposed to 0.03% for the ETF. In any case, I hope you all found this video helpful. If you haven't already, please remember to like this video and subscribe to my channel, and be sure to hit that notification bell so that you are notified every time I drop a new video. Thank you all for watching. I'll see you all next time.